Here's what nobody tells you about crypto wealth. The smartest investors aren't waiting to sell at the top. While everyone else is obsessing over exit strategies, they're using a completely different playbook. And honestly, most people in crypto have never even heard of this approach. I'm going to show you exactly how ultra high net worth individuals turn their digital assets into a personal ATM without triggering a single dollar in taxes. No selling, no capital gains, just pure tax-free liquidity whenever they need it. Stick with me because by the time we're done here, you'll understand the exact framework billionaires use to fund their entire lifestyle while their crypto portfolio continues growing in the background. Let's be real for a second. When you think about your crypto holdings, you're probably stuck in this binary mindset, either HODL forever or cash out and pay the tax man. But here's the brutal reality of selling. Let's say you've got Bitcoin or XRP that's finally hit your target. You sell, feels amazing for about 5 seconds. Then the tax bill arrives. Federal long-term capital gains, that's starting at 15%, going up to 20% for higher earners. Add in state taxes depending on where you live, and suddenly you're handing over 25% to 35% of your gains. If you held for less than a year, now we're talking short-term capital gains taxed as ordinary income, potentially 50% or more when you factor everything in. Picture this. You've built a $1 million position, you finally decide to take profits, the government immediately takes $250,000 to $350,000, gone just like that. A quarter to a third of everything you work for, every risk you took, every sleepless night watching charts. There has to be a better way, and there is. The ultra-wealthy figured this out decades ago with traditional assets. They don't sell, they borrow. Think about it. When Elon needed $44 billion to acquire Twitter, did he liquidate his Tesla stock? Absolutely not. He borrowed against it, used his holdings as collateral, zero tax event, full control maintained. This strategy has a name in wealth circles, asset-backed lending. Some people call it infinite banking. The concept is beautifully simple. Your appreciating assets become your collateral. You borrow against them, and because debt isn't taxable income, you access cash completely tax-free. And here's the kicker. What's been standard practice for stocks and real estate is now available for crypto. The infrastructure exists. The institutional partners are ready. You just need to know how to access it. Path 1, institutional custody lending. The premium route. This is the approach I personally recommend for anyone serious about building generational wealth with crypto. Here's how it works. Your assets move into institutional grade custody. Think of it like a Fort Knox for digital assets. We're talking segregated accounts, bankruptcy remote protection, insurance up to $100 million. Your family doesn't need to understand seed phrases or hardware wallets. It's as simple as a traditional brokerage account, except it's holding your Bitcoin, XRP, Ethereum. With proper custody in place, you can access credit lines with these terms. Loan to value LTV, typically 30 to 60% depending on the asset. Bitcoin's at the higher end. XRP currently sits around 45 to 50%. This means if you've got $1 million in crypto, you can borrow $300,000 to $500,000 against it. Interest rates, right now we're seeing 8 to 15% annually. I know that sounds high compared to a mortgage, but stay with me. We'll break down why this still crushes selling and paying taxes. The safety net. This is crucial. Unlike DeFi protocols that liquidate you instantly during volatility, institutional lenders give you time. You get 24-hour notice minimum if there's a margin call. They'll work with you because they want you making interest payments for years, not liquidating your collateral in a panic. We just saw one of the biggest liquidation events in crypto history. Our clients using this structure, not a single forced liquidation, zero. Meanwhile, DeFi users got absolutely wrecked. Requirements: you'll need an LLC or trust structure holding the assets. There's basic KYC. As long as you're not a bad actor, you're fine. Funding typically happens within 24 hours. sometimes as fast as 30-45 minutes. The future. As crypto becomes more mainstream and banks enter this space, which I'm expecting late 2025 into 2026, these rates are going to compress dramatically. We could see single-digit interest rates by early 2026. Early adopters will benefit from refinancing opportunities, just like real estate investors who started with high rates in the 80s and refinanced their way to wealth. Path 2. DeFi protocols, the fast and furious route. For those who need speed and don't mind higher risk, decentralized lending platforms like Arvin and Compound offer an alternative. The upside: no KYC requirements, instant liquidity, literally seconds, permissionless access 24/7. The downside: automatic liquidations with zero human intervention, no one to call when markets dump, smart contract risk. If the protocol gets exploited, your collateral is gone, variable rates that can spike during market stress. Here's my take. If you need $10,000, $20,000 for a few months, and you've got plenty of collateral to cushion volatility, DeFi can work. You're in and out fast. But anything over $50,000 or for longer time frames, the institutional route is worth the extra steps. The protection alone justifies it. Path 3. Private placement life insurance. The dynasty route. This is the strategy generational wealth families use. It's sophisticated, expensive to set up, and requires serious capital, minimum $5 million in most cases. Here's the framework. You fund a specially designed life insurance policy over multiple years, typically 5-10-year funding period, to avoid it becoming a modified endowment contract, which kills the tax benefits. Inside this policy, you can hold virtually any asset: crypto, real estate, private equity, stocks, private credit. As the cash value grows from asset appreciation, you can borrow against it tax-free. The beauty? Everything inside the policy grows tax-deferred. When structured correctly, your heirs inherit it tax-free. It's the ultimate estate planning tool. The catch? This is complex. You need professional guidance, registered investment advisors, insurance specialists who understand these structures. It's not a DIY project. For US citizens, you're limited to funding with cash initially, then acquiring assets inside the policy. Non-US citizens have more flexibility. You can potentially transfer assets in kind through offshore structures in Bermuda or Cayman. This isn't for everyone, but if you're building 8 or 9-figure wealth and thinking multi-generational, this is the gold standard. Now, here's where most people mess this up. They borrow money and just spend it. New car, fancy vacation, lifestyle inflation. That's not the play. The wealthy use borrowed capital to acquire more income-producing assets. They're playing a different game entirely. Let me paint you a picture of how this actually works. Example: you've got $2 million in XRP. You borrow $400,000 against it at 10% interest. Being conservative, that's $40,000 per year in interest payments. Instead of blowing that $400,000, you deploy it strategically. $150,000 into a cash-flowing rental property, $100, 000 into staking high-quality crypto that generates yield, $100,000 into a diversified portfolio of dividend stocks, 000 reserved for interest payments over the next year. Now your borrowed capital is generating income. Maybe that rental property nets $1, $200/month. The staking rewards throw off another $, $800/month. Dividends add $, $300/month. Suddenly you've got $2, $300/month in passive income, $27,600 annually. Your $40,000 annual interest is covered with $12,400 to spare, and you still own all $2 million of your XRP, which continues appreciating. As XRP grows in value, your available credit line expands. You refinance at better rates as the market matures. You borrow more. You acquire more income-producing assets. The cycle compounds. This is the infinite banking concept in action. This is how real wealth is built. The question everyone asks, but how do I make the payments? Several approaches work. Strategy 1. Productive deployment. Use borrowed funds to generate returns exceeding your interest rate. Real estate. Yield-bearing crypto protocols. Business investments. Anything producing income to service the debt. Strategy 2. Strategic reserves. Set aside a portion of borrowed funds specifically for interest payments. If you borrow $500,000, maybe you allocate $60,000 to cover interest for the loan term, leaving $440,000 for deployment. Strategy 3. Appreciation refinancing. As your crypto appreciates, you refinance and extract more capital to pay down or restructure the original loan. Your collateral value keeps growing, giving you more flexibility over time. The key principle: you're using your crypto's appreciation to fund everything without ever triggering a sale. Here's something most people never consider. What happens to this debt when you die? Smart answer: term life insurance covering your outstanding crypto-backed debt. If you've borrowed $1 million against your $2 million crypto portfolio, you get a $1 million term policy. Annual premium depends on age and health, but it's typically far less than the tax savings you're generating. Why this matters: your heirs inherit the full crypto portfolio without having to liquidate anything to pay off the debt. The life insurance proceeds settle the loan. The assets transfer to them according to your estate plan, often with a stepped-up cost basis that eliminates embedded capital gains. You've utilized your wealth during your lifetime, you've avoided taxes, and you've passed it on intact to the next generation. That's the complete picture. People get hung up on interest rates. 15% sounds expensive, they say. Let's do the real comparison. Scenario A: you sell $1 million Bitcoin position, long-term capital gains tax, $250,000, assuming 25% effective rate. Net proceeds, $750, 000. Lost future appreciation on that $1 million, incalculable but potentially massive. Scenario B: you borrow $750,000 against $1 million Bitcoin at 15% interest. Annual interest, $112, 500 due. You keep full exposure to Bitcoin's appreciation. After just 2.2 years of interest payments, you'd have paid the equivalent of the tax bill, but you still own the Bitcoin. If Bitcoin doubles during those 2.2 years, your position is now worth $2 million. Your tax savings alone justified the interest cost multiple times over. This is before considering what you did with the borrowed capital. If you deployed it productively and generated returns, the math becomes even more compelling. The question isn't whether you can afford the interest. The question is whether you can afford to sell. Let me share an actual situation. Client bought XRP at 50 cents, accumulated 4 million tokens. When XRP hit 50 cents, their $2 million position became collateral for a $500,000 loan. Had they sold $500,000 worth, they'd have owed roughly $100,000 in long-term capital gains, assuming their basis was very low. Instead, they borrowed, paid approximately $50,000 annually in interest, deployed the capital into commercial real estate generating 8% cash-on-cash returns. 2 years later, XRP is substantially higher. Their available credit line has expanded dramatically. They've refinanced once already at a better rate. The real estate investment has appreciated and is throwing off enough cash flow to cover the interest payments plus provide additional income. They still own all 4 million XRP. They accessed $500,000 in liquidity. They've built a cash-flowing real estate portfolio, and they've paid zero capital gains tax. That's the power of this strategy in action. Look, the difference between building lasting wealth with crypto versus just riding the volatility comes down to one thing: implementation. Everything I've shared isn't theoretical. These strategies are being deployed right now by investors who understand that simply holding crypto isn't enough. You need structure. You need protection. You need a systematic approach to extracting value without destroying your cost basis. This is the Rockefeller method applied to digital assets. The wealthiest families in history have used these exact principles with traditional assets for generations. They borrow, they never sell, they pass appreciating assets to heirs, they compound growth across multiple generations. The infrastructure now exists for digital assets. Institutional custody partners are ready. The tax advantages are extraordinary. The only question is whether you'll implement this strategy or watch from the sidelines. The window to structure this correctly won't stay open forever. As crypto becomes mainstream and more people understand these mechanics, the early mover advantage diminishes. If you're ready to think like an institutional investor instead of a retail trader, I want to invite you to go deeper on these concepts. We've built a community of over 9,000 people actively implementing these strategies, from complete beginners just starting their crypto journey to 8-figure portfolio holders structuring dynasty-level wealth plans. Whether you're looking to understand crypto custody solutions, lending arrangements, entity structuring, or advanced estate planning with private placement life insurance, we cover all of it in detail. The choice is yours, but remember, the wealthiest people in crypto aren't the ones who timed the perfect exit. They're the ones who never exited at all. If this resonated with you, smash that like button, subscribe for more wealth building strategies, and I'll see you in the next one.